You are watching Nvidia make history by raising $25 billion through its first major investment-grade bond sale since 2021. The company originally aimed for $20 billion, but investor demand pushed the final figure significantly higher. More than $85 billion in orders poured in, showing how strongly the market believes in Nvidia's future. You can see that the AI race is no longer just about innovation. It is increasingly about access to massive pools of capital. The broader technology industry is expected to spend over $700 billion on AI infrastructure in 2026 alone. Nvidia structured the debt across 7 tranches ranging from 2 years to 30 years. This maturity ladder gives the company flexibility while reducing refinancing risks. You are witnessing a shift where balance sheet strength is becoming just as important as technological leadership. Despite holding billions in cash, Nvidia still chose to access debt markets. That decision highlights how expensive the next phase of AI expansion has become. You should recognize that relying solely on internal cash generation may no longer be the most efficient path for AI leaders. Nvidia's move allows it to preserve liquidity while continuing to pursue aggressive growth opportunities. The company avoided issuing new shares, protecting existing shareholders from dilution. You can interpret this as management expressing confidence in the long-term value of its stock. The transaction demonstrates how credit markets view Nvidia as a durable force for decades to come. Investors accepted relatively tight spreads, signaling strong confidence in the company's financial position. You are seeing the AI boom evolve from a growth story into an industrial-scale investment cycle. Massive capital commitments are becoming prerequisites for maintaining leadership in AI hardware. Nvidia's strategy reflects the reality that future AI dominance may require unprecedented financial firepower. You should pay attention to how liquidity itself is becoming a strategic competitive advantage. The proceeds are designated for general corporate purposes, leaving room for significant strategic moves. Many analysts believe acquisitions could become a major use of this newly raised capital. You can also expect supply chain investments to be a priority as chip demand remains intense. Maintaining strong liquidity gives Nvidia the flexibility to respond quickly to emerging opportunities. L-Impact Solutions highlights that every large capital raise should be evaluated beyond the positive headlines. The firm points to the possibility of circular financing risks within the AI ecosystem. You should consider the implications of AI startups purchasing Nvidia hardware using funding linked to Nvidia itself. If AI application demand weakens, those customers could reduce spending dramatically. Such a scenario could create unexpected pressure on Nvidia's revenue growth. L-Impact Solutions argues that investors should monitor customer concentration and funding dependencies carefully. You are also seeing major cloud providers invest heavily in their own custom AI chips. Microsoft, Google, and Amazon are all working to reduce reliance on third-party hardware vendors. This creates a potential long-term challenge for Nvidia's pricing power. You should not assume that today's demand levels will remain unchanged indefinitely. Raising debt today effectively represents a bet on sustained AI infrastructure growth. Even modest margin compression could affect the economics of carrying additional debt. L-Impact Solutions emphasizes that capital discipline becomes even more critical when large amounts of cash are available. You have probably seen examples where technology giants destroyed value through poorly timed acquisitions. Excess capital can sometimes encourage empire building rather than focused execution. Nvidia must prove that every dollar raised has a clear strategic purpose and measurable return. You should view capital allocation quality as a key performance indicator over the next few years. One recommendation is dedicating a significant portion of the proceeds to future-oriented research initiatives. Investments in quantum computing and neuromorphic technologies could reduce future disruption risks. You would likely benefit from seeing Nvidia expand recurring software revenue streams alongside hardware sales. Diversification can help reduce exposure to cyclical infrastructure spending patterns. Strengthening supply chain resilience remains another critical strategic priority. L-Impact Solutions recommends creating strict barriers between venture investments and revenue recognition activities. You should appreciate the importance of transparent credit risk management in a rapidly expanding ecosystem. Regular stress testing can reveal vulnerabilities before market conditions deteriorate. Expanding deeper into healthcare and automotive markets could diversify future revenue streams. You can see how broadening end market exposure reduces dependence on hyperscaler spending cycles. Active management of debt maturities can prevent refinancing pressure during economic downturns. Maintaining substantial cash reserves provides protection against unexpected industry shocks. You should remember that resilient companies raise capital when they have access to it, not when they desperately need it. The ultimate lesson is that the next decade's winners may combine technological leadership with exceptional financial discipline. L-Impact Solutions believes Nvidia's long-term success will depend not only on building the fastest chips, but also on deploying this $25 billion with precision, discipline, and strategic foresight. Can AI growth justify $25 billion of debt forever? Comment below. To learn more analyses, link in bio. Thank you.